How are you? Can you hear me okay?
Hey.
Yeah.
Yes,
Loud and clear.
loud and clear.
Perfect. Excellent.
So when Steve stops sharing the screen, you'll be able to, Mike.
There we go.
Alrighty. Let's get that going.
So it's great to have an optimistic guy like you and with what's going on in our world. And, you know, before we get going, Mike, wasn't there a date that you talked about in your last interview, some vote? It may have been in Italy in September, or maybe it was August. It was going to have major implications for the euro.
That might have been a different guest. I'm not sure. I was more focused. Yeah.
All right,
I know
it could be.
You have a lot of us on, so.
Okay. So, all right. Interesting bond formation here. What are you thinking? That there's another push to new highs in bonds?
Well, you know, what's been really interesting to me, and you look at the recent pullback we've seen in corners of the stock market, particularly dramatically overbought and overowned technology. We've seen the dollar index kind of try and find its footing after obviously a long period of selling off. Things like the Japanese yen starting to tick up, and volatility look like it's carving out a little bit of a attempted low here. A lot of things seem to be coming together to suggest that we've gotten to the point where monetary policy essentially has exhausted itself, and we're at the point where if we don't get fiscal and don't get fiscal before too long, the markets are going to have a real issue, because they're going to finally be accepting, you know, we've pushed asset valuations as much as we can. You know, Wall Street's gotten its benefits out of what the Fed's been doing. Yes, sir.
Just a question, sorry to interrupt.
Sure.
You know something, we've talked a lot about, and they talk a lot about fiscal policy, and you know, my point about it is that there is no more any difference between fiscal and monetary policy. Yes, the delivery method is completely different, but in essence, having all countries being over indebted, any type of fiscal intervention needs to be monetized 100%. So in essence, you know, how different is it, right?
Sure. I think it's different in terms of what it impacts and how it gets traded.
Yeah, it's the delivery method.
You know,
yes.
Yeah, and I think that, you know, if we had aggressive fiscal or, you know, traditional fiscal policy and less aggressive monetary, I think you'd see in the markets, you'd see the tilt between trading Wall Street beneficiary type instruments and Main Street beneficiary instruments change quite a bit. I mean, if you look at, for example, you know, from the March low through a couple months ago, you know, what kinds of stocks and what kinds of sectors were doing very well? It was all the stuff that was sort of re-inflationary. It was, you know, you saw the big rally and things that were completely beaten down, cruise lines and financials and retail and you know, those kinds of things. You know, you got when fiscal aid was being thrown at the unemployed, when you were mailing out stimulus checks and so on, you tended to see a nice bounce rally, whatever you want to call it, in those names. But as that impulse has kind of faded, it's been you know, up until a couple weeks ago or a few days ago, it's been the growth. It's been the low interest rate forever, weak growth, but secular demand supports tech and so on trade that's been evident in all the markets. So it really changes the character of what's going up the most, what's not, what's struggling, and what's.
It's who gets the money.
Yeah. So
right? Is it the banks or is it the people?
The only problem being is that, unfortunately, with balance sheets, country balance sheets being what they are, it is impossible to have fiscal stimulus without having monetary stimulus run.
The Fed buying the.
Yeah, exactly. Run at full capacity, because there is no fiscal space to actually allocate this type of resources without completely destroying bond prices if there isn't a central bank buying them.
Yeah, yeah. I mean, no, I agree. I agree with you. I do agree with you there, and I think that we're in an environment where, again, where the impulse, the benefits, the recovery money that was thrown at the economy is clearly starting to run out here. And you know, you guys were earlier talking about the political environment, and well, with the election coming up, isn't the Trump administration or Congress going to try and push something through here to help? And I actually, it's kind of funny to me, because I think what we've seen via extremely aggressive monetary policy, because that has sort of neutered the market reaction function, the ability of markets to panic and therefore force fiscal action. The Fed's out there every day begging for fiscal action. A lot of, Janet Yellen wrote her op-ed, whatever, a few weeks ago in the Wall Street Journal and so on, asking for fiscal. But the Fed itself, by neutering that volatility and that forcing mechanism, is making fiscal action less likely. So it's sort of this ironic situation where
we needed that. We needed more pressure on the market.
By the way, good thing that the Federal Reserve was created to be independent.
Independent. I'm going to put quotation marks around that.
Yeah, a lot of them actually.
I wanted to ask you something, Mike. I've been watching this sell-off, and I keep an eye on the yields and TLT. And I've noticed the past few weeks with weakness in the market, there's been no bid in TLT or yields coming down much. Does that bother you, being kind of a bomb bull, that we really haven't had the kind of response that we would normally get? It's almost like, a good day in TLT is up a half a point.
No, you're absolutely right. It has been, noticeable in the last again couple of weeks in this, especially because tech. I mean, it's been the sector everybody's in, and it's been getting hit the hardest. You would expect more upside there. What I'm kind of keeping my eye on, again, is that bottoming pattern that seems to be evident maybe in the U.S. dollar, in volatility and so on, and even to some degree in TLT and bond futures. We haven't, broken back out to the upside, but it seems a lot of these instruments are sort of, making that little rounded bottom. You're getting a little bit of this, this kind of pattern here where the previous sell-off is being, reversed, what have you. And I'm watching to see if we can get that. I mean, I truly think that, all this hoopla about Powell and switching to an average 2 inflation target when you couldn't even hit a straightforward 2 target for 10 plus years during the longest U.S. economic expansion in history. I think we're at an environment where people aren't really buying what the Fed is selling anymore in terms of its ability to create inflation, given the tools it's using. So what I'm very closely watching for is a potential upside breakout in bonds. If we don't get it, then that's going to be worrisome for the longer term. But, I've been an advocate of just staying long treasuries and riding the curve towards zero in the longer term, simply because I see a lot of similarities in terms of what our economy faces and for a longer term future versus what we've seen in Japan and Europe already.
Okay. Do you look for any kind of correlation? There's been one, how correlations are, Mike. Sometimes they disconnect from each other. But do you follow what happens in U.S. dollar yen as it, connects up with yields?
Yeah, I do. And that's kind of why we've seen this little move higher in yen futures and so on recently. It sort of caught my interest last week. I put something on Twitter just noticing that when we've seen this happen in the past, it tends to lead to some treasury buying, or tends to be a signal we might see some treasury buying, a rally in volatility and so on. And we've started to see that. So I'm kind of curious if that's going to continue and whether or not this move gains a little bit of momentum. So it's been one of the other things, again, sort of in a cross-market standpoint, that's kept me willing to stay long bonds here, to see how things unfold.
Because I'm thinking that we may have had an important possible turning point. You have you're looking at the futures. Where we took out that high from a couple of months ago and we're back underneath it. What would be your view if U.S. dollar yen in futures started heading down again? Would that give you pause for your bullish bias in bonds?
Yes, it would. I mean, I think that's definitely something that I am watching here. It is, again, as you mentioned, a little modestly concerning. We're not seeing more oomph to the upside here in bonds, given what's happening in other markets. So yeah, I mean, I'm not aggressively long, jumping in with both hands kind of thing here. But I do still have that long bias, and nothing that I've seen has really changed that. Again, from sort of intermediate to long-term perspective.
Yeah, watch the end, buddy. All right. So, what are you seeing? You have the bonds up here. Are you starting to take into, or are you a believer that it matters who wins the White House in November?
You know, I try to be as apolitical as I can, because obviously I have my own feeling about politics. But
Yeah,
you know,
I know
when it
what you
comes to
mean.
when it comes to the markets, I try and keep check that stuff at the door. But in terms of a market impact, clearly I think if it was a strong Biden win, and he's able to really muscle Congress behind the idea of fiscal stimulus, aggressive fiscal stimulus, then that would be more of a game changer, I think here. I don't really see that happening again, because whether it goes, regardless of the election results, if you go back to the history of TARP, or if you go back to even this March, and you look at what catalyzes and inspires Congress to get off its keister and implement
A
policy,
crisis.
it's a crisis, right?
And that doesn't even work anymore.
Yeah, and so you look at all the money that was thrown at the economy in March. It was happening because the Dow was going down 700-800 points every day, or what have you. You go back to the TARP vote, and what happened? The first vote fails, the market tanks
Right.
8%, and then they turn around and voted in favor 2 days later. Without that mechanism, again, and I don't know that the election results in and of themselves are going to deliver that kind of market volatility, because whether you're talking about a Biden administration or another 4 years of Trump, both of them are putting a ton of pressure on the Fed to continually be easy, continue to support asset prices, and that's not going to change, in my opinion, regardless of who wins. So, unless the markets take control, unless Powell sort of loses that ability to, use his words to coax asset prices higher, we're not going to get that forcing mechanism that gives us aggressive fiscal.
Okay. So besides bonds, what's on your radar here?
We've talked. I think the last time we spoke, and in longer term, I've been a big precious metals bull since late 2018. Obviously, we've seen that market consolidate for a number of weeks now, whether it's gold, silver, and so on. And I think we're still holding levels here that are pretty significant. And I think longer term, I haven't really seen that bullish environment change. Again, it goes back to kind of how the Fed is going to try and get us out of this. It goes back to what's going to happen with interest rates. I mean, I kind of jokingly call it ZERP forever, with quotation marks around forever, but that's essentially what the Fed's locked us into. And if you look at the Euro-dollar futures market and so on, nobody's expecting, anything to really happen at the short end for years and years, or not much at all. And I think, if that sort of Japan, Europe thesis is accurate, then we're not going to be raising rates until a year that starts with the digits 203, if that. So in that case, you don't have competition coming from the interest rate markets for metals. You still have issues of what I call a need for chaos insurance or volatility insurance. People are finding it in metals, and all of those kinds of factors, to me, I don't think are going away. So I think if you haven't been involved in the metals market, this is a pretty good chance to get on board. You have seen that consolidation, but I think that the overall long-term picture still looks
by
solid.
weakness in metals, you think that there's a shot we pull back to your first blue line, a shade under 1800?
Yeah, I mean, I think that's kind of, in my opinion, that's sort of a worst case, short to intermediate term pullback. I mean, we're finding support in this area here, high 1800s or so. It's just like with bonds. I mean, it does bear watching. I wouldn't go crazy, adding long positions here, because you do want to see the character of this correction and whether it does find support. But again, that bias, I guess, longer term, I haven't seen anything to change that approach there.
You're a very fundamental guy, and I understand correlations just because I watch how market moves. What is it behind a weaker yen that could put a ceiling on gold and put a ceiling on bonds? Because if I'm right about the yen, there could be more downside in gold as well. If I'm talking about the other way around, the way we trade cash, it's U.S. dollar yen, not yen U.S. dollar. And I know it's very early, but I can build a case for a 120 yen, which I don't think would be bullish. Which really, and I don't know. The other thing is, why are people assuming lower rates forever just because Powell says it? If you look at the 10-year yield chart, it's so neutral. It doesn't look bearish to me. It just looks like a guy in a coma. And maybe, Mike, we rally and take out that green moving average you have at 97 and head up towards, 120, 140, maybe 2%. How can that happen if the Fed is saying we're not even thinking about raising interest rates?
I think if the market was truly convinced that real economy inflation was coming back, not the asset inflation that we've had as a result of monetary policy and so on, I think if the bond market was truly believing in that thesis and thought that we can in fact reinflate effectively, then you're absolutely right. Yields would be going higher. But I mean, I look at what's happening here as not just reflective of policy, but also the bond market just not believing it's going to work. Again, of course, the central banks, whether it's the Fed or overseas central banks, have much more power or control or a tighter grip on the bond markets than they have in many, many years. But still, we all know from history that the bond market eventually is going to win that battle if there's a reason to. If there was panic about real economy inflation, a lot of this stuff working, people would be selling bonds. Institutional investors would be selling them. Foreign investors would be selling them, and we'd see that reflected in yields. I think the sort of coma that's going on in terms of interest rates is reflective of just the belief that we're going to be in this Japan/Europe environment for quite some time. So, I think if anything, and especially if you look at, for example, the action in the financials in the last few days, I mean, sharp breakdowns in there. And I know people are going to say, oh, it's all this headlines about these FinCEN reports on money laundering and so on. But to me, that's trying to, I don't know, just overthink it.
Trying to explain something that's been, already weak.
Yeah,
right?
I mean, and again, I could just cycle through these charts. I mean, there's companies like Wells Fargo that are sort of like the American version of Deutsche Bank, but even the big name brokers and banks and so on, the charts don't look all that good either. So I think that is reflective of the idea that we're going to be in this ZIRP environment for a long time, and banks aren't going to have that that yield curve, those fatter net interest margins to play with. So,
well, can't there be one other reason for yields to go up besides inflation, like too much supply, not enough demand, and a weaker currency?
Sure. I mean, Martin Weiss and I obviously have talked a lot about, what he saw firsthand in the late 70s, early 80s, and, bond auctions being basically boycotted and the Treasury having to go hat in hand and nobody stepping up to buy. So we know that dynamic can come into play. What I see, though, again, is if I'm sort of using that template in my head of thinking about what's happened longer term in Japan and Europe and so on. Yeah. I mean, Japan's, one of the issues with higher debt loads driving interest rates substantially higher, unless there's a pure buyer's strike a la 1980 or 1981, that kind of environment. In general, all this debt that we keep issuing is ultimately disinflationary when you think about it. I mean, if you have companies and individuals that are adding so much, have historically been building up the amount of debt they have, it takes a smaller and smaller increase in interest rates before it breaks the economy. I mean, one of the key reasons the Fed funds has continued to top out at a lower and lower level in each economic cycle since the early 1980s is that debt levels have spiraled higher. So, I always look at it as people can think of like the idea of an adjustable rate mortgage, right? If you have a $100,000 adjustable rate mortgage and interest rates go up 50 basis points, you probably don't even really notice your payment, right? If you have a $500,000 adjustable rate mortgage because house prices are so much more expensive or you have so much more debt on your balance sheet and so on, you notice a 50 basis point increase in terms of the impact on your budget. And that's kind of where we're at overall. And again, that sort of disinflationary impact of all that debt, to me, argues more for a Japan situation, if anything.
Because it doesn't go into anything productive. It's just servicing the debt.
Correct. You have to dedicate more and more. Yeah, exactly. You have to dedicate. The more debt you have, whether you're a company or individual or whatever, the more of your monthly cash flow and income you have to dedicate to debt service. And again, and that helps suppress interest rates or drive them lower, because if interest rates go up by a smaller amount amortized over a much larger amount of debt, guess what? It breaks your budget at a lower level of rates. So,
okay. Anything else you wanted to share with us today, Mike?
No, I would keep a close eye on, on equities here, and especially on the Nasdaq. I mean, that's not necessarily any wonderful or anything that other people aren't also talking about, but I think it's very interesting that for the first time in a long time we are seeing loss of momentum. We are seeing some, we've seen so many of these junky IPOs dumped on the market. We've seen so much momentum in a handful of technology names. We've seen ratios of growth to value get stretched to levels I haven't seen, and the numbers show you haven't really seen since the peak of the dot-com bubble. So it doesn't mean, this is it. It doesn't mean that necessarily we're going to just crash from here, but it is noteworthy to see that all these things are extremely stretched, and sort of everybody's in the pool on that part of the market. So I'm watching closely the character of this bounce we've seen over the last 36 hours or so. Is it going to gain momentum, or is this going to be the second sort of failed bounce that we have after a huge run up? And if that's the case, if people are no longer sort of buying Powell, buying tech, that this very crowded trade is continuing, it's going to be a sign that maybe something bigger is afoot here.
Okay, Mike, a real nice overview of risk and bonds and yields and precious metals. What's the best way for people to follow your excellent work?
Sure. Anybody can go to our website for my firm, Weiss Ratings. It's www.weissratings.com. I write a weekly column that's in the rotation every Wednesday that they can sign up to get there for free, or they can follow. I try and be as pithy and whatever, depending on how many cups of coffee I've had on Twitter. So if people want to follow me for sort of shorter and quicker tidbits about what's going on in the markets, they can follow me at Real Mike Larson.
Mike, it was real having you, buddy.
Awesome.
Thanks so much for being with us and coming in and sharing your views. And I respect your opinion. So thank you, my trading warrior brother. Good luck going into the fall trading season. I hope you have a great fall, you and all your subscribers, and that your words help and aid and edify people like they did today here.
Thank you. Really enjoyed it.
Thank you, Mike. All right, everyone, that's a wrap on Turnaround Tuesday. We'll see everyone tomorrow. Good hunting, and remember, don't just count your bonds, your bullion, or your babes. Count your blessings. Talk to you guys later. See you tomorrow. Adios. You're welcome, Richard, Sam, Didier, DJ. See my trading warrior brothers and sisters tomorrow. Adios.